On to our next presentation, which will be delivered by Ronald Millos from Teck Resources. Ron Millos was appointed Senior Vice President, Finance and Chief Financial Officer of Teck in October 2005. He joined Teck Corporation in June 1995 as Assistant Controller and progressed through various management positions within the company and its subsidiaries. Prior to his current position, Mr. Millos was Vice President and CFO of the Fording Canadian Coal Trust and Elk Valley Coal Partnership from 2003 to 2005. Prior to joining Teck, he was a Senior Manager at KPMG. Mr. Millos holds a Bachelor of Commerce from the University of British Columbia and has completed Harvard Business School's Advanced Management Program. He is currently a member of the Canadian Institute of Chartered Accountants and the Institute of Chartered Accountants of British Columbia. The title of his presentation is Restructuring During the Credit Crunch, Teck's Experience. Please join me to welcome Ron Millos.
Well, thanks for your time. I was asked to do this presentation many, many months ago, and at the time I thought, you know, things are pretty good now. Why do we want to go back and revisit history? But it looks like the cycle perhaps might be turning. Knock on wood, let's hope it's not as bad or as long, or if we're lucky, it won't even happen. But some uncertain times today. I apologize for this. Our lawyers tell me I have to put this in any presentation I do, so I'll skip over it and assume you can read it. Teck today, just briefly, we're the largest diversified miner in Canada, #1 producer of metallurgical coal in Canada, #2 exporter of metallurgical coal in the world, top 3 zinc miner, and copper growth. We're looking at 150% increase in our copper growth. So that's the company in a snapshot. We are America's focused. All of our producing properties are in North and South America at this time. We do have exploration properties in various locations around the world. And our focus really is on copper, metallurgical coal, and zinc at this time. And we have some oil sands projects that are not yet in the production stage, but hopefully they will be producing for many, many years at some point in time in the future. So I just want to go back to 2008 and talk about a transaction that we did. We were the 40% owner of the Elk Valley Coal Partnership, which had 6 coal mines in southeast British Columbia and 1 in Alberta near Hinton. On July 29th, we entered into an agreement to acquire the Fording's Coal Trust interest, 60% interest in those assets. And that was basically close to a $14 billion deal, US $82 cash and 0.245 of a Teck share. And the intention was that we would partially finance that acquisition with a US $9.8 billion term loan, of which $5.8 billion was due in a year and $4 billion was a 3-year term loan. And that involved 29 different banks in the lending syndicate. September 29th, the lenders, a syndicate financed during the economic crisis. September 30th, the Fording unit holders approved the transaction, and if you knew what happened with share prices back then, it was a bit of a no-brainer at the time. And then on October 30th, the transaction closes, and I'll go through some of the commodity prices and our share price impacts in a couple of slides. So what we had planned was that this transaction would be fully funded using a customary bank bridge financing. That's normal. You can't do a transaction without having financing in place. That's the regulatory requirements in Canada. We had our investment grade credit ratings reaffirmed, so we had gone to the rating agencies, Moody's, S&P, and said, here's what we're planning on doing. We want to maintain our mid-investment grade credit rating. Are you okay with this transaction? They did their review, required us to run numerous scenarios, upsides, downsides, whatever they wanted. And they gave us the indication that, this transaction would not have an impact on our credit rating. And that was done with an all-cash deal. We subsequently decided to put in about $1.5 billion of equity into the transaction. So we confirmed the transaction on September 30th. It closed on October 30th. After we had announced the transaction, we were out on the road doing what's referred to as a non-deal roadshow, and that's our plans were that we were going to go to the marketplace and raise, $5 billion of 5, 10, 30-year maturities as part of the financing package. And if things had gone according to plan, we would have had that in place before we actually needed to tap into the bridge facilities. And the advantage of having that in place versus going with these bridge or term loans is you avoid the fees that come along with that. And we were also contemplating whether we might be interested in bringing a minority partner into the coal partnership, say a 20% interest to help finance the acquisition. Market reaction was very favorable. One of the interesting things is when you do a transaction of this size, you normally expect your share price to drop. Our share price rose, and by quite a substantial amount for a few days, and then it started to fall. And the general feedback from the marketplace was very positive that this was a good deal. And part of the rationale was the way the Fording Coal Trust was structured. We didn't really buy the assets. We bought a royalty interest in the assets, and that had some very favorable tax consequences. It added about $3 billion of net present value to the deal. And because of the way the tax rules work in Canada, we effectively got a $1.1 billion cash tax refund because we could carry these tax pools back against the taxes that we paid in prior years, because as a mature company, and with the run-up in commodity prices, we were paying a significant amount of Canadian income taxes. So market conditions, after we announced the deal and before it actually closed, the beginning of the financial market collapse, Lehman Brothers declared bankruptcy, and the credit markets effectively dried up. Nobody was lending. Copper prices, commodity prices dropped off the face of the earth. Copper at the time we did the deal was about $3.67 per pound. It dropped down to $2.04 by the closing date. Coal prices were about $300 per ton. Some people were selling coal up in the $350, $370. There was expectations that the next year's coal price would rise even further. And then this was at the time of the transaction. Subsequent to that, there was concern that the coal price would drop to below $100 per ton. Customers were not honoring their obligations. When the steel mills stop producing, they don't need the coal, and it's not like you can store a couple of $100,000 of coal. It just takes up a lot of space. So physically, they weren't able to take the coal. So not only were we weren't getting the volumes for the high price coal, and then the price dropped off at the beginning of the next coal year. It didn't drop off as low as people thought, but it was still a low price. Other things that happened, the U.S. exchange rate, was whipsawing, went from $1.03 to $1.29. Fording took the position that as an income trust, it made sense for them to have a nice stable margin and stable cash flows that they could then distribute to their investors. So they took the position where they would hedge the U.S. dollar when they knew what their coal price was. They had done that at about close to par. And when we bought the assets, that the hedge book came with it. Exchange rate went the wrong direction, and we were writing checks of about $70 million a month for about 6 months at a time when we didn't have the money coming in from the lower sale prices. In addition, with the drop-off in copper prices, the way the copper works is you sell the product. You get a down payment of about 85% based on the prices at that time, and then final settlement will be 2-3 months later, depending on the terms of the contract. With the rapid drop, we were actually refunding instead of collecting the final 15%. So it was basically everything was going the wrong direction for us, as we had low prices, cash going out the door when you're expecting cash to be coming in the door. This chart just shows the copper prices. You can sort of see where it was when we announced the transaction, where it was when it closed, and that was very painful. Next slide here is the coal prices. They were up at the $300 at the time the. Oh, sorry. I'll go back one just. So there's the copper price. From the beginning of 2008 to the where it is, I guess, the end of the summer here when I put the slide together. Coal prices, back at that time, we were on an annual pricing environment. So when you sold coal, you negotiated the price for the coal year, which was April 1 to March 31st, which is effectively the year end for the Japanese steel producers. Set the price for a year, and a year later, you'd pick up a new price. Recently, we've moved from that annual pricing environment to a quarterly pricing environment. So the volatility is still a volatile commodity, but just not as volatile as it's been in the past. And it's in our view, it's a better pricing scheme because neither the supplier or the customer really gets hurt badly for a long period of time if there's a rapid change. U.S. dollar exchange rate. That was the comment I made on the hedge book, and you can sort of see roughly, Fording put the hedge books in place at roughly the par or 101 level, and they had over $1 billion of hedges in place at the time, so it was a painful exercise for us. Our share price obviously took a beating. You can sort of see when we did the transaction over in this period, and then for a few days afterwards, it spiked up. What one would normally expect for this type of a transaction is a bit of a fall off in the price, and that's sort of what the empirical evidence suggests when you do a transaction is the acquirer's price drops down because of the risk of integration, whatever. So, it went up and our heads swelled up and said, what a great deal we've done, and then it sort of fell off the face of the earth. Transaction closed around $12. We were down as low as, I think it was $3.15 in the bottom down in March of 2009. And the implications of this is it gets the banks nervous, because if your share price is high and the credit markets dry up, you go to the issue some shares. Well, at $3, you got to issue an awful lot of shares to raise the money. So that's really the implication of the share price. We've subsequently recovered, and this goes out, I guess, to about the current prices. But in April of 2009, we refinanced or renegotiated the terms of the bridge financing and effectively stretched out the maturity dates. We lost our credit rating in that period as well, so interest rates went up. We paid a lot of fees, but we bought ourselves some time to get through the crunch. Shortly after that, we went out to the markets and did a $4.2 billion bond deal, and that was at high yield rates. We were now non-investment grade, so our rates were probably a little over 10% on average. But at that time, that was the first big deal that really had been done in North America following the credit crunch. So there were a lot of bankers that were very happy to see that deal get done, because it sort of reopened the markets again. The interesting thing that, when we went through the process down around the closing date, all the banks were supposed to send the money into one of the banks. And then the next day, the money would then go out to Computershare, whoever distributed the funds to the various shareholders. The banks did not trust J.P. Morgan with overnight money at the time. So that's the chaos that was going in the financial markets at the time. So it was very, very difficult environment to be working in. So our response to the situation that we got ourselves into is that, we had about a 20% reduction in our met coal production in response to the weaker demand from the steel customers. We had a 20% reduction in the refined zinc that produced a trail. We closed the Pend d'Oreille zinc mine. It's on care and maintenance right now. It's an operation that if we saw longer-term favorable zinc prices, we could consider a reopening there. We did a 13% reduction in the workforce, operates a significant reduction in G&A and exploration expenditures. Unfortunately, when times are tough, the admin people and the geologists usually take the brunt of those cuts. Operating cost reduction initiatives at all of our operations proved successful. They were all cash flow positive at the current prices at the time, and even though we took a bit of a beating in 2008, we still made close to $700 million. All the operations were running cash flow positive, so they were good quality assets. And the issue we found ourselves in was we're in a credit crunch. We couldn't refinance the debt before it was maturing. We had planned capital spending reductions of roughly $500 million, cut it down to about the $500 million level. Sustaining capital was minimized. Operations remained, well capitalized. Development projects were limited to those projects that were already in process and nearing completion. So anything that hadn't started or could be stopped was stopped at that time. We curtailed any of the expenditures on some of the early stage development projects. So anything that was in the feasibility stage, et cetera, that was just shut right down. The Fort Hills mine-only decision, that was deferred, and the upgrader development on that particular project decision was put on hold, and we suspended our dividend, and that at that time was about $490 million of cash savings. And that's something that, although it's painful for shareholders and market reaction is not favorable, it's a very, very positive signal to send to bankers if you're in the situation where you have to renegotiate your lending agreements. So the first steps, we announced those on November 30th. That was the dividend cut, operating costs, sustaining capital, development capital. Talked about the tax refunds. That was pretty much well known there. But we received a portion of the tax refunds in the latter part of 2008, and then got the big check in 2009. Started the asset sales process to get rid of the non-core assets that we had. The one thing that we were lucky for, we did not have to get rid of any of our crown jewels type things. So the assets that were sold were not core to our operations. December and January, we announced the temporary shutdown of the Ponder A mine. The Fort Hills decision was made. The global workforce reduction was made, and the announcements on the coal production cutbacks were made. Going to the capital spending, our sustaining capital was reduced to about $250 million from about a $600 million annual spend run rate at that time. Development capital reduced down to $250 from about $900 million that were under our original plans. We continued with the short-term projects. The Carmen Andacollo concentrate project was in process and just about done. We continued with that project. Continued with the Highland Valley Mine Life Extension project. And then the Quebrada Blanca, Hypogene development, the Valencio, Galore Creek, Frontier, and Equinox, which are a couple of oil sands properties, those were put on hold. And again, Fort Hills was deferred. There we go. Sorry. Non-core asset sales. Gold portfolio, we sold off the gold stream. Gold is a byproduct of our Andacollo operation to Royal Gold. That provided roughly $200 million of cash and some Royal Gold shares. We sold our Lobo Marte property for $140 million. Our Hemlo gold mines are sold to Barrick for $65 million. We sold the Pogo gold mine for $245 million. And our Morelos property for $150 million. El Brocal was a zinc property in Chile that we sold. We were looking at a minority interest in the Teck coal partnership was being considered. That did not happen. And we sold a 1/3 interest in the Juanita hydroelectric facility, which provides power to Trail, and that generated cash of $825 million. But that transaction didn't close until 2010, but it was announced much earlier. And under the amended terms of our the loan agreements, it permitted asset sales, but yet to give the proceeds to the bank. So that's something that's likely to happen if you find yourself in a similar situation. So the debt rescheduling that we went through, and that was a kind of a lengthy process. We were working on that basically starting right after the transaction closed, because we knew we had some challenges facing us. But we effectively deferred about $4.4 billion of the obligations that were due to mature in 2009. And the table below shows you how we shifted the money out. The $3.5 billion replacement for the bridge facility was moved out to 2011. And of course, the terms of the revisions of the revised agreement, the banks take a lot of money. So there's fees at certain points in time that you have to pay if you're not fully settled, or if the balance exceeds certain amounts, there's additional fees. So when you find yourself, or if you ever find yourself in this situation, there will be a lot of pressure to make sure that the banks get out of this thing first. Term facility was amended. Basically 85% of the term lenders agreed to this amendment, and those that didn't just continued on with the existing terms. So it was really an opportunity to take something that was due short term and stretch out the terms. And of course, again, at the time, we had already lost our investment grade credit ratings, so this thing was fully secured. There was lots of limitations on what you could do, what you could spend money on, all that sort of stuff. Shortly thereafter, we went to the market and raised $4.2 billion of high-yield notes, $1.3 billion at 9.75%, $1.1 billion at 10.25%, $1.8 billion at 10.75%. So much higher cost than what we had originally anticipated when we did the transaction. Shortly thereafter, in July, we issued US $1.5 billion of private placement to CIC China Investment Corporation, and that was roughly 100 million Class B shares. That gave them a 17.2% economic interest and about a 7% voting interest. We have a dual class share structure. So, and that was a passive investment. They had a minimum hold period, standstill commitment, so they couldn't sell. There's limitations on who they can sell those shares to, and at the time they had no board representation, or had no opportunity to have board representation on the company. So it was a good, from our perspective, it was a very positive investment to have, a nice passive investor that gave us lots of insight into what was going on in China. Commodity prices, recovered better than a lot of people expected. So that US $9.8 billion bridge financing was paid off in full by the end of the second quarter of 2010. Total debt at the closing of the transaction was about 13.4 billion Canadian. We had pushed that down to 5.7 billion by the end of June of 2010. A lot of that was through the asset sales, the debt issues. But that debt level was a debt level that we would anticipate to have sort of ending up in had we moved ahead according to plan. The terms were a lot different than we anticipated, but the magnitude of the debt was very similar to what we had hoped for. And then in 2010, we did US $2 billion of new notes, and we took out a portion of those high yield notes. So we now have notes maturing in 7, 10, and 30 years. And that retired debt that had an average maturity of 6 years and replaced it with debt with an average maturity of 18 years. So that gives us lots of room for other opportunities. And the coupon on that debt was reduced to about 5% from roughly 10.25%. So the summary of our plan basically is go after the operating costs, shut down operations that weren't providing, get the tax refund in as quickly as possible. Our tax group moved heaven and earth to get the tax returns done at ASAP. We had a good relationship with the CRA people. So once the returns were filed, they reviewed it quickly, got the process back to Ottawa for final approval, and we had the cash, pretty much the bulk of the cash by February. The tax refund, the reason it was an issue is nothing unusual about what we did there. It was a CDE pool, which is a 30% declining balance deduction. It's very common. What we were concerned with was the dollar magnitude of the refund, that people would take a bit harder look because it was such a big check. But there was no issues there, and that was good. Sustaining capital development projects and the dividends, those were key. Fort Hills was key because at that time, Fort Hills was a very, very costly, expensive project, and a lot of the oil sands projects were slowing down at that time. Asset sales, rescheduled, the bank debt were key, and $4.2 billion bond issue and the strategic investment by CIC all turned out to be godsends for us. If you go back, you may have heard about the 12-step plan. I'm not sure we've ever laid out the 12 steps because at a point in time, a lot of them were confidential, so we never really talked about them. So with this one, it's all done. It's easy to talk about. It's all public information. So in summary, if you find yourself in this type of a situation, the thing is prepare a worst-case scenario. We prepared worst-case scenarios, we thought. And they were run by, the 29 banks. They were run by the rating agencies. It just got way worse than we thought. So that was one lesson that we learned from the place. Also make sure you've got an exit plan. Like if you're into something and it just turns out that it's not what you thought, know ahead of time how you're going to get out of it. That's always helpful. All the asset sales, production, curtail, closing operations, think about those in advance because curtailments and closing operations is not as easy as you think because you've got union issues to deal with. Depending on the jurisdiction you're in, if you close an operation, sounds great, but all of a sudden you advance the reclamation work. So you need to understand that it's a more difficult. Capital spending sounds like an easy decision. Stop doing it. But if you stop your capital spending, are you going to continue to be able to produce at the levels that you want? So you cut the capital, maybe you're cutting the production, which means further cuts into the cash flow. And that may not happen this year, but it may happen several years out. So you cut this year, you never seem to catch up. Like you're always sort of trying to catch up. So you're further behind in your development projects going forward. Know the assets that you want to sell. Know the assets that you could sell because if you get yourself in trouble, everybody's more than happy to take your crown jewels from you at a very low price. And of course, if you sell your crown jewels, you're left with the stuff that is going to get you nothing. So you just put yourself into a bit of a death spiral if you sell the wrong assets. Look at hedging opportunities. Problem is you need to look at them before you do the transaction. If you look at it after the transaction and you've lost your credit rating and your credit risk, the banks will pull your credit lines and you won't be able to hedge. Nobody will want to do business with you. So it's something that you need to consider up front versus at the back end. And all other discretionary costs, cut the hockey games and the travel and entertainment, all that sort of stuff. Cutting the dividends is critical. If you're having to deal with the bankers or you want the banks to renegotiate your lending agreements, it sends a very, very powerful message to the bankers. It doesn't send the same powerful message to your shareholders, but if you have to do that, it generates a lot of goodwill. And ensure your planning models are current and flexible because, if you've got some old dinosaur planning model that you're using, the banks will ask for hundreds of different scenarios. I don't know how many we did, but we were doing 3 and 4 a day sometimes. Every week, the banks wanted an update. Try this price deck. Try that price deck. What happens if your asset sales that you've announced come in 3 months later, or 2 months later, or a year later? Like they just bombard you with the stuff. So you want a tool that you can run those scenarios very, very quickly. Same with the rating agencies. They'll be asking for lots of different scenarios. What's also critical is that you maintain a very positive relationship with the bankers and the rating agencies. Like, you can't go silent, okay? Because if you're not telling them what you're up to, they start to panic. And you need to communicate your plans and the progress against those plans on a regular basis. You need to be proactive with the communications. Don't wait for them to call you. Don't hesitate to pick up the phone, visit the bankers, meet with them. And your non-financial staff need to be prepared to meet and provide significant amounts of detailed information on what perhaps can be very short notice because when the banks are in town, they want to meet. One of the things that Don Lindsay, our CEO, did is very early in the process, he went and visited the CEOs of all of the major Canadian banks and some of the key American banks and said, here's what we're up to. And, one of the CEOs said, boy, am I glad you're here because I'm meeting with the board tomorrow and we got $1 billion of exposure to you and they're going to be asking me so I can say, he was in, I met, I heard, and here's what they're up to. So that type of, and we, had monthly letters to the banks, lots of phone calls between Don and the CEO. Of course, the finance team and the other people that were involved with us were on a communication on a daily basis with the people at the banks that actually had to get into the detail. Expect significant changes to your lending agreements if you get into this type of situation, and you have to understand in advance what is workable for you. As an example, we had a debt equity ratio of 50% or 60%. I can't recall what it was, but with the way the exchange rate was moving at that time and the magnitude of the US dollar debt that we had on the books, a change in the exchange rate could put us offside that credit ratio. Nothing really changes, but you're offside, and then the whole house of cards comes tumbling down. So you need to understand that. Other examples would be, you can't move money from one of your corporate entities to another corporate entity in excess of X dollars. That'll get you in trouble. Well, we have a captive insurance company in the Caribbean, and one of the other provisions was you have to maintain a proper insurance program. So if you can't move money from one company to the captive insurance, you can't maintain your captive insurance company. So you get lots of things like that. Lots of, think of non-cash transactions that happen. You've got all these different write-downs and things like that. And can you carve those out? Because the banks at that stage are concerned about cash, not necessarily earnings. But there's a whole laundry list of things that you have to worry about. Payments to employees. We had a unit plan, so employees got the phantom units that would pay out 3 years after they vest. You can't make a payment to employees in excess of X dollars. Well, if your share price had gone up beyond a certain level, and with the number of units that were outstanding, you'd be offside that provision. So, you meet the requirements of one agreement, and you're offside the requirements of the other agreement. And the terms and the agreements are, you need the lawyers to decipher their laundry list. Everything's a defined term. You're flip-flopping back and forth. You've got terms that are inconsistent from one agreement to another. You have to make sure they're all tied together, because this stuff is all done when you're in desperate shape. It's all done very quickly, and you're scrambling to get things done, and it really is a challenging environment. Request relief from your suppliers and your service providers. You'll find out very quickly who your friends are. And some are very helpful, and some are not so helpful, and you can think about how you want to do business with them down the road. But in our case, most of them were accommodating to some degree. And be prepared to deal with staff morale issues. There's a lot of depressed people wondering if they're going to have a job. They've probably lost a fortune in their pension plans, just nothing to do with us, just because of the way the market was. On top of that, these units that we talked about that pay out, they were valued at about $50 on the day we announced the transaction, and they were worth about $4 when they paid out. So a lot of people took a substantial hit. A lot of people's options that were expired out of the money. You need to be mindful if you have options and you're involved in this type of process that you're privy to a lot of inside information. So you're watching your share price drop like a rock. I better cash in these options, but you're negotiating with the banks. You can't trade. And you just watch it fall off the table and say, dang, nothing you can do about it. So, but that's life. So, and then you got the talk going around the water cooler and people sort of not focusing on what they should focus on. And, I'm very happy to say that we had very little of that. And the employees were very, very supportive, and they rolled the sleeves up, and nobody was pointing fingers. Like, I remember going to one of our leadership training sessions, and what we do with that is we sit in a room, and three of us get up there and give a chat, and all these young guys that are the up-and-comers in the company get to ask us questions. And we did one of these shortly after we did this transaction. It was myself, the business development guy, and the lawyer. Three key guys in negotiating this deal. And I was just looking at these people, and all I could think was they're thinking, these are the three stooges that got us into this trouble. That was going through my mind as you're trying to explain your way out of this thing. And but with hindsight, they're good assets that we bought. Our debt level is where we thought it would be. The terms are not exactly what we thought it would be, and we've had a pretty good run. We're caught up in the down cycle like everybody is right now, but just understand what you're getting into, and have an exit plan, and you can survive it. It will be painful. There'll be a lot of sleepless nights. Lots of times I was made at home to have a shower so I could get back to the office. You can't sleep. It's your stomach's churning nonstop. But what you have to remember is the banks don't want to own a mining company. They want you to get through it, and that's the underlying thing. So they're going to work with you. And make sure you're open and honest and communicative, and you'll be able to get through it. Now, if you have lousy assets, that's a totally different story. If you have good assets, you'll be able to get through these challenges. But it's difficult and it's expensive, but you can get through it. So with that, I'll open up to any questions.
Are there any questions before we head out? Comments? Just have actually one question for Ron. Is there anything in today's economic environment that would make you change your 12-point response plan if you had to respond again in the near future?
No, I think all of those points are things worth considering. It may be, depending on the circumstances, some of them just you throw off the table at a point in time. Like if you don't pay dividends, you don't have to cut the dividend type thing. You may not have assets that are saleable. So there's lots of things. When I talk about renegotiating the loan agreements, it wasn't just the loan agreement for the transaction, but it was all of our other loan agreements. So they all have to be brought together because the banks don't want somebody to have a preferential position to them. So not only did we renegotiate the financing loan agreements, it was all the other background agreements, our revolvers and all that sort of stuff. The most important thing when you're getting, in my view, when you're getting into amendments to your agreements is really to understand what you can and can't do and whether that's actually practical in your situation, because I gave you a couple of examples just to make the point, but those things are very, very hard to pick out under the crunch. So you need you need your accountants to look at it, make sure they understand what the definitions are, because in these agreements, the lenders and the lawyers put all these definitions in which you think make sense, but they're totally different when you actually read the agreements. So EBITDA is not the EBITDA that you would think it is. It's a defined term, and to find out what it is, it's EBITDA equals this defined term, less that defined term, plus that defined term. So you got to go to all three of them and make sure you understand completely what's in each one of those. So, dealing with the banks, we had 29 banks to deal with, which is a large number. Now, you're dealing with a couple of the leads that sort of herd the cattle type thing, but every single one of those banks would have looked at this stuff and would have got their licks in. Some of them talked to us directly, some of them would have been dealing with the other lenders. Try and understand what the needs of each of them are, because you think you're making progress in one area and then something comes up and you're trying to get a sense for what the issue is, who's raising the issue, how you can deal with it and satisfy them that it's not an issue. But if you've got a good relationship with your lenders, you got a real good chance of success. If your lenders hate you, could be difficult times for you.
Thank you. Let's just thank Ron Millos. One question.
All right. Thanks.
That is it for our morning session. We'll reconvene at 2 p.m. Thanks.